Okay, so thanks for sending us all this stuff about the markets, all these articles and things. It's super interesting, right? I mean, we're always trying to figure out this whole market volatility thing, especially when you're in it for the long haul, right?
Yeah, for sure. And it's like one of those things everyone wants to know more about,
Yeah.
especially when things get a little, rocky.
Totally. So today we're going to really deep dive into understanding and managing market volatility. But specifically, what does it mean for someone who's not looking to make a quick buck, but really wants to build long-term wealth?
Right. Thinking long term changes everything.
So first things first, right? We got to define this whole market volatility thing. From what you sent us, it seems like it basically means, how much and how often prices in the market jump around in a short period.
Exactly.
Yeah.
And it's, it can be a bit of a roller coaster ride. Makes you want to close your eyes and hold on tight sometimes.
Yeah, for sure. And that's totally natural, right? To feel a little unsettled when you see those numbers bouncing all over the place.
Uh-huh. But here's the thing, right? For long-term investors, volatility isn't necessarily a bad thing in itself. I mean, think about it. Markets are always going to have their ups and downs. It's part of the game.
Okay, so dips and spikes are normal, you're saying?
Yep. I mean, short term, yeah, they can be a little scary.
Yeah.
But if you zoom out, if you take that long-term perspective, it's less about those day-to-day or even month-to-month changes.
So it's don't sweat the small stuff, focus on the big picture.
Exactly.
Okay, I like that. So the big question, the thing we really want to unpack for everyone today is how can you, as a long-term investor, ride these waves? How do you navigate all the ups and downs and actually reach those financial goals you've set for yourself?
It's a great question. And it's one that, there's no one-size-fits-all answer. But there are some, core principles and strategies that can make a huge difference.
Okay, perfect. Let's get into it. So the first thing that jumped out from all the material you sent was this idea of staying invested, which, might sound kind of counterintuitive when the market's doing crazy things.
Right, like hide your money under the mattress.
Aha, exactly. But seriously, why is it so important to resist that urge to pull everything out when things get shaky?
Well, think about it this way.
Mm.
Historically, markets have this incredible ability to bounce back, right? Even after some pretty major downturns. And the thing is, if you try to time the market, if you sell when it's down and then try to buy back in when it's going up again,
Yeah, good luck with that.
you're really running a huge risk. You could end up missing out on the best days of recovery, the days when the market makes its biggest gains. And guess what? Those gains are often concentrated in a very small number of days. So if you're not in the market, if you're sitting on the sidelines, you miss out. And that can have a significant impact on your long-term returns.
That's a really good point. So it's not about being right all the time. It's about being there for those key moments.
Absolutely. And let's be real, consistently predicting those moments is basically impossible.
So staying invested is key. Okay, what's the next big piece of the puzzle?
Well, diversification. It's the classic advice, right? Don't put all your eggs in one basket.
We hear that all the time, but honestly, what does that actually mean in practice when the market is going haywire? How does it actually help?
So picture this. You've got your money spread across different types of investments. You've got stocks, which are pieces of ownership in companies, bonds, which are essentially loans to governments or companies, maybe even real estate, actual property.
Right, so you're not putting all your faith in any one single thing.
Exactly. And even within stocks, there are different sectors, right? You've got tech companies, healthcare companies, energy companies, all sorts of things. And they don't all move in the same direction at the same time.
So what you're saying is if one area takes a hit.
Yeah. If tech stocks, let's say you're having a rough time, maybe those healthcare companies or consumer staples companies that make the stuff everyone needs, no matter what those might be doing just fine, even going up.
Yeah.
So you're kind of cushioning yourself, right? Your entire portfolio isn't as exposed to any one area's performance.
Okay, so it's spreading the risk around so that even if one part of the market is having a bad day, your whole portfolio isn't completely tanking.
That's it.
I see, I see. So staying invested, diversifying your portfolio, those are the first two big takeaways. But what about actually putting money into the market during these uncertain times? I mean, that can feel pretty intimidating, right?
For sure. No one wants to feel like they're, throwing money away.
Yeah.
And that's where dollar cost averaging, or DCA, comes in. It's a really helpful strategy for navigating these ups and downs.
Okay, so what is DCA in plain English?
It's pretty simple, actually. It's basically investing a fixed amount of money at regular intervals, like, say, every month, no matter what the market's doing. So you're not trying to, time the market perfectly, catch it at its lowest point.
So you're taking the guesswork out of it.
Exactly. And here's what happens. When prices are high, your fixed amount buys you fewer shares. But when prices dip, you're automatically buying more shares for that same amount of money.
Ah, okay. So over time, you're kind of averaging out your purchase price. You're buying more when it's cheaper and less when it's more expensive.
Yeah, precisely. And that can really take the pressure off, trying to pick the absolute best time to buy. It's a disciplined approach that can, help smooth out the ride.
I like that. So staying invested, diversifying, using DCA, those are all really helpful strategies. But we're human, right? We've got emotions, and those emotions can really mess with our investment decisions.
Oh, absolutely. Our brains are wired to, protect us from danger, which in the caveman days was like lions and tigers and bears. But nowadays, our brains sometimes see a market dip as a similar threat.
Right, like fight or flight kicks in, even though it's just numbers on a screen.
Exactly.
Hmm.
So understanding and managing our own behavioral biases is super important. Like, one big one is loss aversion. That feeling that losing money is way more painful than gaining money is pleasurable. And that can lead to panic selling, even when it goes against our long-term plan.
Oh, yeah, that makes sense. Like seeing your portfolio drop in value, even if it's temporary, it can feel really unsettling.
Uh-huh. And then there's herd mentality, right? We see everyone else doing something, and we just want to follow the crowd, even if it's not the right move for us.
Oh, totally. Like if everyone's selling, you start to think, oh, no, maybe I should be selling too.
Exactly. And the opposite can happen too, right? When the market's booming, we get FOMO, fear of missing out, and we jump in, maybe even when prices are inflated.
Yeah, we don't want to be the only ones not making money.
Right. So recognizing these biases, being aware of our own tendencies, that's a big step towards staying calm and making rational decisions, even when things feel a little crazy.
So it's like knowing yourself and your own tendencies is as important as knowing anything about the market itself.
Couldn't agree more.
Okay, so we've talked about staying invested, diversification, dollar cost averaging, and managing our own emotions. Now, here's something that on the surface might seem kind of unrelated, but all the material emphasize the importance of having an emergency fund.
Yeah, it might seem a little off topic, but it's actually super important for overall financial stability, which definitely impacts how you handle market swings.
Okay, so remind me, what's an emergency fund and why is it so crucial in this context?
It's basically a stash of money that's easily accessible, set aside specifically for, unexpected stuff, job loss, medical bills, car repairs, that kind of thing.
Oh, right, like a safety net.
Exactly. And having that safety net means that if something unexpected happens, you're not forced to sell your investments, maybe at a loss, to cover those costs. Your long-term investments can stay put and hopefully recover with the market.
Okay, that makes total sense. It's like having a separate bucket of money for those just-in-case moments, so you don't have to raid your long-term investments when you're maybe not thinking clearly.
That's it.
Okay, so emergency fund, check. Now let's talk about our actual investment portfolios. How often should we be looking at them, tinkering with them, especially when things are volatile?
Yeah, it's tempting to check it constantly, right?
Oh, I'm so guilty of it. Like every time the market moves, I'm like, oh, let me see what's happening.
I totally get it. But actually, all the experts, all the stuff you sent, they basically say that constantly adjusting your portfolio based on those short-term market swings, it can really backfire.
Really? So less is more in this case.
Pretty much. The general recommendation is to review your portfolio periodically, like maybe once or twice a year. And the goal of those reviews isn't to react to every little thing, but to make sure your investments are still aligned with your long-term goals, your risk tolerance, that kind of thing.
So it's like course correction, not constant micromanaging.
Exactly. Unless your situation or goals have drastically changed, you don't want to be making decisions based on short-term noise.
Makes sense. It's about staying focused on the long game.
Yep. And speaking of the long game, a huge part of that is how you structure your investments in the first place. That's where asset allocation comes in.
Okay, so what exactly is asset allocation? It sounds kind of technical.
It is, but it's super important. Basically, it's how you decide to spread your money across different types of assets. Remember we talked about stocks, bonds, real estate?
Right, spreading the risk.
Exactly. Asset allocation is deciding what percentage of your money goes into each of those buckets. And that decision is based on a few things. Your risk tolerance, how much fluctuation you're comfortable with, your time horizon, how long until you need to use the money, and of course, your overall financial goals.
So, like someone younger who's saving for retirement way down the line, they might have a higher risk tolerance, put more into stocks, right? And someone closer to retirement might be more conservative, put more into bonds, for example.
That's a good general rule of thumb, yeah. And a well thought out asset allocation strategy. It's designed to manage risk and, potentially boost your returns over the long haul.
Okay, so we've got our asset allocation figured out. But then things change, right? The market moves, some investments go up, some go down. That initial balance gets thrown
Yeah,
off.
that's where rebalancing comes in. It's basically adjusting your portfolio back to your original target allocation.
So why is that important, especially when things are volatile?
Well, imagine this. Stocks have been on a tear, right? Doing really well. So now they make up a much bigger chunk of your portfolio than they did before. But that also means your overall risk level has gone up, maybe more than you're comfortable with.
Right, so rebalancing is like a way to reset, bring things back into balance.
Exactly.
Yeah.
You might sell some of those high-flying stocks,
Yeah.
take some profits, and then use that money to buy more of the other assets that haven't done as well, bringing everything back to those original percentages.
Okay, so it's like systematically taking some off the table when things are good and buying more when things are down. A disciplined way to manage risk and capitalize on those ups and downs.
That's the idea.
Okay, so we've talked about a lot of strategies, but are there certain types of investments that can inherently help smooth out the ride a bit?
Yeah, actually, the stuff you mentioned, defensive stocks,
Hmm.
these are companies in industries that, people need no matter what's going on in the economy.
Right, like essential services, right?
Exactly. Think utilities, healthcare, consumer staples, those companies that make the stuff everyone always needs. Electricity, medicine, food.
Right, because even if the economy's struggling, people still need to keep the lights on, stay healthy, and eat.
Yep. So these companies, their earnings and stock prices, they tend to be a little less sensitive to those big economic swings. And that means they can be a good option for investors who are, particularly concerned about volatility.
So they can add a bit of stability to the portfolio, maybe offset some of the riskier stuff.
Exactly.
Cool. Okay, so we've talked about a ton of things we can do during volatile times, but honestly, maybe the biggest thing is our mindset, how we think about the whole thing. And that's where having a long-term perspective is so crucial.
It really is. I mean, that's kind of the overarching theme here, right?
Yeah.
If you're in it for the long haul, those short-term ups and downs, they matter less.
So how does that help us practically? How does having that long-term view actually make a difference?
Well, it keeps you focused on those big goals, right? Retirement, buying a house, funding your kids' education, whatever it is. It helps you avoid getting caught up in the daily news cycle, the constant chatter about what the market did today or this week or whatever.
So you're not reacting to every little blip. You're looking at the big picture, the overall trend.
Right. And historically, if you look at the long-term performance of the markets, they tend to go up, even with those inevitable dumps along the way.
So it's about trusting the process, believing that over time, things will work out, even if there are some scary moments along the way.
Yeah, it takes some faith, for sure.
Now, speaking of the long term, there's another big factor that can really impact our returns, our purchasing power.
Inflation.
Ugh, inflation, right? Everyone's talking about it these days. And it's a real concern because it basically eats away at the value of your money over time.
Right. So even if your investments are going up, if inflation's high, you're not really getting ahead as much as you might think.
That's the tricky part.
So what can we do about that? Well, you can look for investments that have historically performed well during periods of inflation. Like some people put their money in equities, stocks, because they tend to grow faster than inflation over time.
So stocks as a potential hedge against inflation.
Yep. And there are also things like inflation-protected securities, specifically designed to, keep pace with inflation. So those are a couple of options.
Okay, good to know. So we've talked about stocks, but what about bonds? How do those fit into the picture, especially during volatile times?
Bonds are generally considered to be less risky than stocks. They tend to be less volatile, so they can add some stability to your portfolio.
So it's like having a little bit of a safe haven in there, right?
Kind of, yeah.
Uh,
And especially during times of market turmoil, high-quality bonds, like government bonds or those issued by really solid companies, those can be a good place to park some money.
because they're less likely to freak out when everything else is going crazy.
Yeah, they tend to hold their value better. Though it's important to remember that not all bonds are created equal. Some are riskier than others.
Right. So some bonds are more bond-like than others.
Exactly.
Okay, good to know. We've mainly been talking about investing in the U.S., but what about looking beyond our borders? How do international investments play a role in all of this?
International investments are a great way to further diversify your portfolio because, different countries, different regions, they have their own economic cycles, their own things going on.
Right, so what's happening in the U.S. might be totally different from what's happening in, say, Europe or Asia.
Exactly. So when the U.S. market is struggling, maybe other markets are booming. And by investing internationally, you can potentially tap into those growth opportunities, smooth out the ride a bit.
So it's like not putting all your eggs in the U.S. basket. Okay, that makes sense. Now, we've been throwing around this term volatility a lot, but there's also this term bear market that we hear a lot. What exactly is a bear market, and how should we, as long-term investors, think about it?
A bear market is basically a prolonged period of decline in the stock market. Typically, it's defined as a drop of 20% or more from a recent high. And it can last for, several months, even years.
Okay, so it's like a serious downturn, not just a little blip.
Yeah, it can feel pretty intense.
Yeah.
But the key, again, is that long-term perspective. During a bear market, it's super important to avoid panic selling. Remember what we talked about earlier? Selling when the market is down locks in your losses.
Right. It's like the worst thing you can do.
Pretty much. Instead, focus on your plan, stay the course. Some investors even see bear markets as an opportunity.
An opportunity. How
Yeah.
so?
Well, if you have some cash available, a bear market can be a chance to buy high-quality assets at a discount. It's like a sale on stocks.
Okay, I see. So it's like turning a negative into a positive. But that takes some serious mental fortitude, right?
It does, yeah. It's not for everyone,
Yeah.
but for some people, it can be a really smart move.
Okay, so maybe volatility, even bear markets, they're not always the enemy.
Exactly. They can be opportunities in disguise.
Okay, that's a good way to think about it. Now, one final thing that the material emphasized, and it's super important, understanding your own risk tolerance.
Oh, yeah, this is crucial. You really got to know yourself, how much risk you're comfortable with.
So what does that actually mean, risk tolerance?
It's basically how much fluctuation in your portfolio can you handle without, like, losing sleep?
Hmm.
Do you stomach big drops or do you need something more stable? Knowing that about yourself helps you build a portfolio that you can stick with, even when things get tough.
Right, because if you're constantly stressing about your investments, you're more likely to make rash decisions, right?
Exactly. So understanding your risk tolerance, it's as much about your emotional well-being as it is about your financial goals.
So it's not just about picking the best investments, it's about picking the investments that are right for you.
Couldn't agree more.
And sometimes figuring all this out, it can be a little overwhelming. And that's where, having some professional help can be a game changer.
Yeah, a financial advisor can be a really valuable resource, especially during times like these, when things are uncertain.
So how can an advisor help? What do they bring to the table?
Well, they can provide objective advice, right? They're not emotionally attached to your money the way you are. And they can help you create a plan, a strategy that's tailored to your specific situation, your goals, your risk tolerance.
So it's like having a coach in your corner, someone to help you stay focused and make smart decisions, even when you're feeling stressed.
That's a great way to put it.
Okay, so having an advisor can be really helpful. Now, staying informed about what's happening in the market, that seems like a good idea, right? But we also talked about the dangers of overreacting to every little piece of news. So how do we find that balance?
Yeah, it's a fine line, right? I mean, staying informed is good. It helps you understand the big picture, but you don't want to be glued to the news, freaking out over every headline.
Right, because the news can be pretty sensational, designed to, get our attention, even if it's not really that big of a deal in the long run.
Exactly. So find a few reliable sources, get a sense of what's going on, but don't let it dictate your every move.
So be informed, but not obsessed.
Yep.
Okay. And finally, the material you sent, it had some really good tips on managing those emotional responses we talked about earlier.
Yeah.
What are some practical things we can do to stay calm and rational when the market's going crazy?
Yeah, definitely. So first things first, have a plan. A written investment plan can be like your anchor. It reminds you of your goals, your strategy, helps you stay focused.
So it's like having that roadmap so you don't get lost when things get bumpy.
Exactly. And another thing, review your portfolio regularly, but not obsessively.
Mhm.
Get familiar with your investments, understand what you own. That can really help reduce anxiety.
Because knowledge is power, right?
For sure. And, don't underestimate the power of like self-care, stress management. Get enough sleep, eat well, exercise, all that good stuff. Yeah.
So taking care of your mental health is just as important as taking care of your financial health.
Totally. And maybe limit your exposure to the news, especially those like super dramatic headlines.
Turn off the financial doom and gloom.
Right. And, if you need help, don't be afraid to reach out to a financial professional or even join like a support group, talk to other investors.
So it's like you're not alone in this.
You're definitely not.
Okay, so that was a lot of information, but really, really valuable stuff. So to recap for our listener who sent us all this great material today, we really dug into understanding and managing market volatility, specifically from the perspective of a long-term investor.
Yeah, we covered a lot of ground.
We talked about the importance of staying invested, not trying to time the market, and how diversification can help you manage risk.
And we discussed dollar cost averaging as a way to like smooth out those purchases over time, take the emotion out of it.
We also talked a lot about the psychology of investing, how our own biases and emotions can lead us to make bad decisions, and the importance of having an emergency fund. So you're not forced to sell your investments at the worst possible time.
Right. And then we got into portfolio management, reviewing your investments regularly, but not too often, and the whole idea of asset allocation, figuring out what percentage of your money should be in stocks, bonds, real estate, that kind of thing.
And we talked about rebalancing, bringing your portfolio back to that target allocation, especially when the market's doing crazy things.
We discussed defensive stocks, those companies that can provide a bit of stability during tough times, and the importance of maintaining a long-term perspective, not getting too caught up in the day-to-day noise.
And of course, we talked about inflation, how to protect yourself from it, and how to think about international investments as a way to further diversify your portfolio.
We even touched on bear markets, how they're not necessarily the end of the world, and how they can even present some unique opportunities for long-term investors.
And we wrapped up with some practical tips on managing your emotions and the value of having a financial advisor in your corner.
Phew. That was a lot.
It was, but good stuff.
Absolutely.
So, after hearing all of this, after considering all these different perspectives, what's one action, one thing you're going to do today to strengthen your own long-term investment strategy, even when the market gets crazy?
That's a great question to think about.
Yeah, definitely something to chew on.
For sure.
All right, thanks so much for all the amazing material.
My pleasure.
And thanks for listening. We'll see you next time.